Assalamualaikum and hello everybody. I'm Fakro and I'm your lecturer for this course, Assessing Financial Strength and Viability of the New Startup. This course has been designed for aspiring entrepreneurs who want to understand how to assess financial strength and viability of the new startup firm or companies. Let's look to our chapter objective. There are 4 objectives in this chapter. First, explain the 2 functions of the financial management of a firm. Second, identify the 4 main financial objectives of entrepreneurial ventures. Third, explain the purpose of an income statement, balance sheet and statement of cash flows. And fourth, discuss how financial ratios are used to analyze and interpret a firm financial statement. Before we go into details, let's assume or imagine you are an entrepreneur having a business or few businesses. In business, our major concern is whether we are making money or not. Thus, for every entrepreneur, you need to ask yourself, how are we doing? Are we making or losing money? In order to know whether we are making money or losing money, we need to master financial management. Financial management deals with 2 things: raising money and managing a company's finance in a way that achieves the highest rate of return. Thus, this chapter focuses primarily on how a new venture tracks its financial progress through preparing, analyzing, and maintaining past financial statements. Secondly, we also want to look how a new venture forecasts future income and expenses by preparing pro forma or projected financial statement. When we talk about financial management, we will deal with a lot of questions such as, how are we doing? Are we making or losing money? How much cash do we have on hand? Do we have enough cash to meet our short-term obligation? How efficiently are we utilizing our assets? How do our gross and net profit compare to those of our industry peers? Where will the funds we need for capital improvement come from? Are there ways we can partner with other firms to share risk and reduce the amount of cash we need? And overall, of course, are we in good shape financially? Basically, there are 4 financial objectives of a firm. First, a company's ability to make a profit. Second, a company's ability to meet its short-term obligation. Third, how productively a firm utilizes its asset. And finally, the overall health of the financial structure of the firm, particularly as it relates to its debt to equity ratio. Let's look into the detail. The ability to earn a profit. The goal of every business is to make profit, but many startups are not profitable during their first 1 to 3 years while they are training employees and building their brands. However, a firm must become profitable to remain viable and provide a return to its owners. On the other hand, the ability to meet its short-term financial obligation is also important for every startup. Even if a firm is profitable, it is often a challenge to keep enough money in the bank to meet its routine obligation in a timely manner. The third objective, efficiency, is more on how productively a firm utilizes its asset relative to its revenue and its profit. Southwest Airlines, for example, use its asset very productively. Its turnaround time, or the time its airplanes sit on the ground while they are being unloaded and reloaded, is the lowest in the airline industry. Finally, the last objective, stability, is the strength and vigor of the firm overall financial posture. For a firm to be stable, it must not only earn a profit and remain liquid, but also keep its debt in check. Now, we look into the process of financial management. Why financial management is so important for a firm? Financial statement important for a firm because the firm need to assess whether its financial objectives are being met. Firms rely heavily on analysis of financial statement. A financial statement is a written report that quantitatively describes a firm's financial health. The income statement, the balance sheet, and the statement of cash flows are the financial statement entrepreneurs use most commonly. On the other hand, forecasts are an estimate of a firm's future income and expenses based on past performance, its current circumstances, and its future plans. New ventures typically base their forecasts on an estimate of sales and then on industry average or the experience of similar startup regarding the cost of goods sold and other expenses. On the other hand, the budgets are itemized forecasts of a company's income, expenses, and capital needs, and are also an important tool for financial planning and control. Another process of financial management is financial ratios. Financial ratios depict the relationship between items on a firm's financial statement. An analysis of its financial ratios helps a firm determine whether it is meeting its financial objective and how it stacks up against industry peers. Many experienced entrepreneurs stress the importance of keeping on top of the financial management of the firm. To simplify the process of financial management, let's look to the diagram. First diagram, the column 1, preparation of historic financial statement include income statement, balance sheet, and statement of cash flows. Second column, preparation of forecast includes income, expenses, and capital expenditures. Third column, preparation of pro forma financial statement includes pro forma income statement, pro forma balance sheet, and pro forma statement of cash flow. Finally, the fourth column, ongoing analysis of financial result, includes ratio analysis, measuring result versus plans, and measuring result versus industry norms. The financial ratios of historical data has been used to analyze previous performance. The same financial ratios used to evaluate the firm's historical financial statements should be used to evaluate the pro forma financial statement. This work is completed so the firm can get a sense of how its projected financial performance compares to its past performance and how its projected activities will affect its cash position and its overall financial soundness. This is an example on how historical data has been used to compare performance with the projected performance. By looking to these financial ratios, the firm can measure its performance and know whether it's meeting the target or not. To recap this topic, as an entrepreneur, understanding your financial data is very important in order to develop your business strategies. I'm Fakrul, your lecturer for this course. Remember, action changes things. See you next time. Bye.